welcome everyone to the webinar, Discover Best Practices for Managing FX Exposures from Accenture, FLIR Systems Incorporated, and FiREapps. Global political and economic uncertainty makes understanding the best practice surrounding currency exposure management even more critical than ever. During this webinar, you will hear from renowned global currency expert Wolfgang Koester, CEO of FiREapps, who will speak to best practices for CFOs and Treasurers in managing currency risk related to the Eurozone crisis, China, and emerging markets. We will also have an interactive discussion on currency exposure management led by Andy Gage from FiREapps, featuring Treasury leaders from Accenture and FLIR Systems who will share their insights and firsthand experiences with FX risk management. I would like to thank FiREapps, our sponsor, for helping us make this event possible and at no cost like everything else we do at Performative. A few logistical notes regarding today's webinar. We would like this to be an interactive experience for you, so if you have any questions at any time, please go to the questions area in your GoToWebinar control panel and send us your questions. We can't promise to get all of them in, but we will do our best, and we'll follow up afterwards on any questions we did not get to during our closing Q&A session with all of our speakers. A link to today's presentation video of this webinar will be sent to you and available to all attendees on performative.com. Those who would like CPE credits or NASBA will need to answer all the polling questions we'll have during the event and should have pre-registered for CPE credit. For any questions on CPE credits, please contact Tanya Walsh at twalsh@performative.com. We'll have Tanya's contact information up again later in the webinar. Final logistical note, you'll be asked to take a short survey regarding today's webinar. We'd greatly appreciate your feedback regarding our event today, as we always strive to improve the ROI we offer our event and attendees for their valuable time. A quick word about Performative. Performative is the largest and fastest growing online community resource for senior level corporate finance, accounting, treasury, and related leaders. Performative connects corporate finance leaders to provide instant advice and insights on the tough financial and strategic challenges they face every day. With that, I'd like to introduce our speakers for today's webinar. Randall Finnessy, Vice President, Corporate Treasurer, FLIR Systems. Randall started his career in international banking and interbank foreign exchange trading in Minneapolis, Minnesota. After moving to Oregon, he worked as a corporate foreign exchange dealer before moving to Tektronix, where he advanced up to Assistant Treasurer. Currently, Randall is Vice President, Corporate Treasurer for FLIR Systems, the world leader in infrared technology. Also pleased to have Brian Cowles, Assistant Treasurer, Financial Risk and Liquidity Management, Accenture. Brian is a graduate of St. Mary's University, Minnesota, and has spent 20 years with Accenture in various Treasury-related roles. He has led several large-scale transformational efforts, including fully centralizing the Accenture Treasury function post-incorporation and redefining how they leverage technology to improve Treasury processes. Today, he oversees all aspects of the company's currency risk management programs, as well as the global banking and cash management activities globally. Andy Gage, Vice President of Strategic Market Development, FiREapps. Andy has 20-plus years of experience in FX exposure management, business process reengineering, lean manufacturing, ERP and complex system deployment, marketing and product development management marketing, product management, and consulting. He is currently the Vice President of Strategic Market Development for FiREapps. He's a frequent speaker at Treasury and Finance conferences and educational sessions. He holds an MBA from the University of Texas, Austin, and a bachelor's degree in business from the University of Arizona. Finally, Wolfgang Koester, CEO of FiREapps. Wolfgang has managed risk for Fortune 1000 companies as well as governments, including G10 since 1986. Prior to forming RimTech, he served as the president of GFTA Transnational Incorporated, a quantitative currency manager. Wolfgang holds a Bachelor of Science degree from Arizona State University and a master's degree in international management from the Garvin School of International Management. He has been named one of the 100 most influential people in finance by Treasury and Risk, is a member of Global Exchange's Who's Who in Foreign Exchange, and he regularly contributes to industry publications including Treasury and Risk, AFP Exchange, and GT News. He is a board member of ACI, the Financial Markets Association, and a former member of the editorial board of the AFP Risk newsletter. With that, it is my distinct pleasure to hand the floor over to Wolfgang Koester, CEO of FiREapps. Wolfgang, take it away, please.
Hi, Ernie. Thank you, and thank everybody for joining us today. I think the intention is to first start off with some background of where we see the economy, where we see some of the markets, and then take that on to what our distinct members today are, Brian at Accenture and Randall at FLIR, doing to address that, as well as how are we helping other companies with that. So Let me start off by just making probably a bit of a bold statement, but probably not counterintuitive, which is volatility since 2008 has significantly increased and is here to stay for the unforeseen future. The volatility comes in two areas. One, sudden movements of currencies that can impact and will impact financial results. And secondly, the decoupling of the dollar versus many currencies. So when I look at this thing from a just pure volatility point of view, I'm sure a lot of the people that are on listening today will already have seen significant spike in volatility just in the first couple of weeks of July, which, if they weren't prepared and look to be prepared more, we'll talk some more about that. It's important to be very quick in this new environment in order to be able to act to mitigate risk, because time has become a worse enemy than ever. So with that, let me go on to the next slide there. Really, one of the areas that really makes it even harder for treasuries to accommodate the increased volatility is the addition then to corporations looking for double-digit growth, if possible, in more frontier countries. So the vast majority, as you can kind of see it here, is of Fortune 100 companies, 86% are looking to increase internationally, where only 14% are not. I'm sure pretty much everybody on the phone will be able to attest to that. On the international Fortune 100 companies, 94% of them manage that risk already in some level of form. So people are addressing it, they understand it, they understand that this is an issue, but this is an increasingly difficult issue because of A, the market environment, and B, what already corporations are doing to expand. On the next slide then, I think I want to get into the topic pretty quickly of what's one before that. On the slide of with respect to the euro, I think I've probably been pretty known to be outspoken about this already starting about 18 months ago. I felt that the foundation for the euro is crumbling, and as I still believe is that Germany and France can likely afford Greece and Ireland and Portugal, but when it comes to Spain and Italy, really Germany is not able to A, finance those countries, and B, probably not willing to, because the ability to keep their economy very competitive due to a lower euro versus a higher Deutschmark has the offsetting effect that they have to have costs associated with it. The cost of financing some of the countries will be, would have been and has been positive for Germany, but now with Italy and Spain, that is definitely tipping the other way. There really are only two alternatives to come out of the euro crisis, in my opinion, and one is to significantly devalue the euro, and I think we've already seen some of that happening. That may save it. I still think that that will not be enough to actually end up saving the euro by, and we'll talk about in a second, the middle of 2013. Now, this isn't only impactful to chief financial officers who are trying to really understand the analytics around what is our euro impact and what could this mean, but this is really starting to be also, and I have lots of discussions with boards and CEOs about their concerns. As you can see here, numerous of them have already gone public with this, but believe me, I'm having even more discussions I see with CEOs about their concerns of really making their numbers and what this impact will mean. So if we then go on to the next slide, really depicts the volatility nicely about what is going on, and what we tried to do in this slide here, not the one before, is really to look at the activities of what is going on with the euro dollar, and you can see some significant reference and bailout activity happening over the last 10 to 12 months versus prior to that, kind of from the 2010 framework to roughly the October 2011 framework. So every single time you see a star like that, you see sudden moves in the currencies and consequent volatility increase. I think that what is very interesting here for everybody to watch is what are the dates. So I get a lot of questions, well, what does this really mean, and when could one expect some significant moves in this? At the end of the day, this whole thing moves towards, and that's why I'm looking at the middle of 2013, moves towards the German federal election in September of 2013, where at this point it looks like Merkel's job is significantly at risk. So she's got to figure out one way to address the euro issue, certainly going into the election. So we see continuous volatility in the euro with respect to other currencies. It's going certainly well into the end of this year as well as into the beginning and middle of next year. By that time, we'll have a pretty clear indication of where this is going. I still think that there's a high likelihood that you're going to get some significant movements in there that could significantly alter the existence of the euro. I think that one of the things that is important here to realize, though, as I'm talking to a lot of boards and CEOs and CFOs, is that not only are they concerned about the euro, and that certainly is in the forefront, but also are they looking at China, for example. And you got to look at a few things that are happening there. You're seeing a continuous, somewhat still stringent, but broadening of the bandwidth of the Chinese currency versus the US dollar. But there is a significant undergoing current of the reform of the Chinese financial system in general. You may have seen today, latest today, the article in the Wall Street Journal talking about how now China is positioning itself to be one of the top 3, if not end up being the largest gold trading facility. All these things are moving towards more liquidity within China, decoupling of the currency from certainly the US dollar, and that is going to continue to add challenges. So not as just the euro, but also there are other things like China out there. Brazil is still looking at it. These are issues that all corporations end up having to face and will continue to have to face. So this isn't an issue that's going to go away. At the latter part of 2011, there was a strategic really review done by Accenture looking at what are the criteria success factors for risk management in this new world. I think that some of those things, without reading them, you got to read them through them themselves, and this will be certainly available, is that you do have successful risk management programs are due to impact shareholder values. I think the overall gist that I'm seeing here is that Treasury is becoming continuously and increasingly strategic, and CEOs are recognizing that, CFOs are recognizing it, shareholders need to be recognizing it, certainly at the board level. I think the other part that one should take away from this thing is that Treasury in a closed system, and people are recognizing them, cannot be as successful as in an open system where they are, and I know that both Randall and I'm sure and Brian will, I'm sure, address this. They need to really be able to also talk to other areas of the institution in order to have a well-rounded strategic treasury, because they need data out of the controller section, etc. So as one looks at risk management from a corporate point of view, Treasury is becoming A, more strategic, and B, you're seeing here risk executives being, quite frankly, chief risk officers being established as a position because it grabs over numerous silos within the organization. So it'll be very great and interesting to start getting some inputs from Randall and Brian about that. So as we go to the final slide then, in preparation for this, and I think what we'll end up focusing most time on is you really have to look at 3 areas that we want to address today with Randall and Brian as well. One is we've talked about increased FX volatility, and certainly the speed of change and the timing thereof will impact earnings per share. I'm already talking to companies who are worried about this quarter, Q3, purely because of what happened in the first 10 days of the euro-dollar movement. Increased global expansion, we talked about that already. Certainly the impacts of that will be on earnings per share. Increased global expansion hopefully will have significant, hopefully double-digit impacts on a growth perspective. One needs to be very aware of what is the risk implications for the benefit of the double digit and how can you manage that. And then lastly, increasing operational complexity. sometimes people are in the acquisition modes, otherwise on the organic modes, but the operational complexity from a Treasury point of view as well as from strategic risk management point of view also impact earnings per share and earnings in general. And we're seeing a lot of corporations coming out this quarter, luckily not many of our customers, with respect to how it's been negatively impacting them for Q2. With that, I'd like to hand it over back to Ernie to introduce both Brian from Accenture and Randall from FLIR.
Thank you very much, Wolfgang. I'll go ahead and pass the floor over to Andy Gage from FiREapps, and Andy is going to navigate us through our panel discussion with our other panels today. Andy, take it away.
Thanks, Ernie. What we're going to do in this next section here is we're going to do a quick preview of or overview of both Accenture and FLIR's corporate and risk management environments. We're going to start with Brian. And Brian, perhaps you can just start providing everybody with a little bit better understanding of who Accenture is and the operations, and then we'll talk a bit about your currency risk management environment.
Great. Thanks, Andy. So for those of you who maybe aren't familiar with Accenture, just a little bit of background about the organization. Accenture is a global management consulting, technology services, and outsourcing company. We employ a little bit less than 250,000 people around the globe, and we're actually serving countries in roughly 120 countries. In terms of physical presence in locations, we have offices in approximately 200 cities, but in 54 countries. So we've got a fairly diverse footprint from that perspective. In terms of revenue, our fiscal year end, we'll have another one of these coming up here shortly, but last year we had revenue of just over $25 billion. I guess just to bring this down to earth, in terms of the types of things that we do for our clients, we help clients do large transformational programs that have an IT component to them, such as putting in ERP solutions. On the outsourcing side of things, we will tackle things like application maintenance, perhaps running the technology infrastructure for organizations in that particular space, or even taking over an entire back office process end-to-end, such as a procure-to-pay solution on behalf of our clients. And then, of course, we have the traditional management consulting. We are organized around 5 operating groups that you could see on the bottom of slide 17. I guess to spend just a few minutes on our hedging program on the next slide. Prior to, as Wolfgang had kind of highlighted, the peak of the crisis when it began to unfold, before that, we were pretty actively managing selective currency exposures on our balance sheet. And what I mean by selective are the ones that we controlled, we Treasury controlled, and they're the ones that we knew the most about. So for example, we use a large volume of intercompany loan transactions in our organization, and since cash is typically moving in those scenarios, Treasury is involved from a cash standpoint, and so that enabled us to get our hands around the exposures that those would generate, and we'd be informed as to when they would change. Pretty straightforward. However, given we do operate in a large number of countries, we're a very company code intensive organization, well over 300 legal entities, and we're mainly local currency functional. Suffice to say that there's a lot of nooks and crannies on our balance sheet where exposures could hide, and we weren't necessarily in tune with all of those. As the market really began to become more volatile, and of course everybody's aware of what happened with the U.S. dollar, anywhere where we would have had U.S. dollar denominated assets or liabilities, for that matter, anywhere on our balance sheet would have started to generate some P&L volatility that we may not have anticipated coming through. So once we started to experience this a couple years ago, we set out on an initiative and really set out 4 main objectives. And I guess you could really view these objectives as achievements as well. So I think we pretty well ticked the boxes on each one of these. The first was to take a solution like FiREapps and really do a much better job of identifying and summarizing and categorizing all of the exposures across our multitude of company codes across the enterprise. We do have a single instance of SAP, so that was a good starting point, obviously, from an efficiency point of view. But again, we really have a there's a high volume of account data, a high volume of company codes with accounts that we measure, and so just getting our arms around that was the first thing. The second thing was to be able to identify that data and then really divorce ourselves from the accounting cycle. Our organization, just like most others, we're very tied to monthly accounting cycles, quarterly close cycles, and that's really the way that I think we used to think about exposures. As Wolfgang mentioned, that really doesn't solve the issue anymore, because in a matter of days you can have several digit movements of currency against each other. And so we really wanted to think about, if an entry is made on the 7th of the month, it creates an exposure. Well, let's start managing it on the 7th of the month. The third thing was, now that, once we were able to identify the data, think more about real time, that also gave us the opportunity to really rationalize how we hedged exposures. Making no hedge decisions, thinking about maybe hedging for different periods of time, different maturities, using the data that's in front of us to actually say, is hedging on a month-to-month basis really the right thing to do? And that was something that we were able to do once we had our arms around the data. And then lastly, we also triggered a very large internal transformation effort around all of our IT environment from a finance point of view. But the effort to really look at foreign exchange exposure differently gave us a springboard to really get our local finance teams, get our local entity controllers, our tax people really thinking about the fact that anybody who has the ability to make a journal entry in our organization, and it's a large number of people, can have an impact on creating FX exposure. And so things like clearing accounts on time, making entries into the accounting system on the value dates that the transactions are actually meant to be recorded, all of those things help. And the effort that we undertook with our internal organization was really putting the cap on the overall effort. So happy to elaborate further as we go forward in the presentation.
Thanks, Brian. It's a great foundation, and we'll definitely revisit several of those topics as we get deeper into this. So, Randall, we're going to turn it over to you and have you just quickly provide us a bit of background on FLIR Systems and the currency risk management environment that you've developed over the last couple of years there. And let me go ahead and advance it to the FLIR Systems overview and tee you up. Randall?
Okay. Thanks very much, Andy. So as was mentioned earlier, FLIR Systems is a leader in the infrared technology arena, and we may be most famous and most well known for being featured on Ghost Hunters and Destination Truth, because they're using our cameras and our logo, fortunately, when they're out seeking their monsters and their ghosts. But the company is really based upon a full suite of thermal detection, chemical, radiological, nuclear, biological, and explosive sensor systems. And those will run the gamut from large government systems down to handheld equipment that is used by the local police department, other law enforcement agencies, or hunters and boaters. We have a very large breadth of product line throughout the market, and we are servicing many industries and many end customers. We're headquartered in Wilsonville, Oregon. We have about 3,000 employees, public since '93, but the company was founded in '78 on that original technology. And we've been a member of the S&P 500 since 2009. As we move forward, I joined the company in 2008. The currency risk was being monitored, but not actively managed. And so it was being really orchestrated through the use of leads and lags with intercompany payments. And the company was smaller at that time and less complex. As we saw the increase in volatility and we increased our international operations, there was really a motivation by Treasury and the CFO to more formalize that currency risk management process, as well as to dampen or mitigate the impact that was occurring on the income statement. So the initial focus, obviously, is just to understand the exposures, and we, like Brian, actually are on SAP as well. And so thinking that you had a dynamic database would allow you just to run a very simple report. It should be able to tell you what all your exposures were. Unfortunately, that's far from the truth, and we made several attempts at creating our own processes and our own reports, and that never really got off the ground to a satisfactory level. So then we too turned to FiREapps to really accelerate and to bring in a solution that could be integrated that would get us off and running. We had the opportunity to do some large acquisitions, one of which was located in the UK. They operated on an ERP system dissimilar to us. They were on IFS instead of SAP. And as a result of that, all of their exposures were suddenly outside of our normal reporting process. So we needed to actually bring in a separate ERP system into our consolidated reporting in order to generate a corporate-wide view of the exposures. So once those exposures were understood, we were able to take actions to mitigate the balance sheet portion. And once we had that underlined and under control, we then started looking at the revenue and expense exposures. So we can look at the structure of how we are established with the integration of FiREapps on the next slide. We are combining the output from both our SAP General Ledger and the IFS General Ledger. And those are being brought together within the system, separate downloads, and then combined within the FiREapps application to create all of our exposure management as well as our core analysis and the revenue and expense reporting that we use on a quarterly basis. When we look at the revenue and expense exposure, really the goal was to improve the forecasting and cash management decisions and to understand more of the impacts on the gross margins. Oftentimes when you have a large international organization, the common comment that you will hear at the end of the quarter was, well, we didn't make a particular target because of currency. And that's a really hard comment to prove or disprove unless you have the underlying information and you can actually point to the exposures by currency pair and say that was the truth, or really there must have been something underlying that elsewhere because it's not proving out in the numbers. So for us, we were leveraging the FiREapps application in order to gain confidence in our numbers and to make sure that we understood the exposures. We really went from a 0 to 90% confidence in our numbers because we could tie back, after the initial implementation of FiREapps, we could tie back to the individual accounts, individual currencies, the numbers that were being extracted from the database. So we were quite confident that it was pulling all of the data, and it does it so fast, and within 15 minutes of a day, I can see my exposures across the corporation. That was the great advantage, so that we actually had the opportunity on a repetitive basis to create these numbers without having to take a huge amount of time away from either our IT staff or our local controllers. Organically, we did reduce some of the balance sheet exposures, actually by more than 50% within the first 6 months, by using the exposure intelligence, because we were able to see on a currency pair by currency pair basis who had exposures, which companies were exposed on currencies that were not their functional currency. So it allowed us to start doing offsets. It allowed us to start paying down intercompany balances that weren't being hedged in order to do the natural netting and the natural offsets for us. Our hedging program was initiated with 5 to 10 currency pairs that had a dramatic impact on the EPS volatility as it was associated with the foreign currency gains and loss. And through the process of our core analysis, we actually were able to identify opportunities by hedging additional currency pairs where we could actually have an interest income from the forward points of doing the hedges. Our improved cash management decision-making was based on analyzing the historical impact on our forecasted revenues and expenses. And so we can actually work with between our Treasury group and our accounting group to mitigate some of those those risks on the income statement by, as Brian said, by timing, by making sure that entries are made appropriately, and that we don't get surprises by entries being made in isolation in the subsidiary. We understand that at the corporate level as well. And then we continuously adapt and improve the program using our core analysis to align what we're doing with the value at risk calculation, so we can see the impact of reducing the exposure as well as the opportunities to gain interest income.
Thank you, Randall. That was a great background. I appreciate that. So we're now going to transition into the panel discussion and build upon many of the topics that were just covered by Randall and Brian. And I apologize for the background. I've got a guy that has decided to sand the wall right outside my office. I was trying to get that mitigated right away. But let's go ahead and move into the panel discussion. The topics that we're going to focus on are really fourfold. The first is the impact of the analytics. So how has the analytics really played a role in both the case of Accenture and of FLIR? How have they built upon that success to build on the organic exposure elimination that Randall referred to? And then we'll also step into some of the tools around risk analysis, such as what we refer to as the core analysis, and how that can help our clients in other companies really understand their cost and risk trade-offs as they're managing their currency risk management program. So let's move into the first panel discussion, the impact of analytics on FX and the Treasury function. Brian, perhaps you could share just a moment or just a couple of comments about how does the analytics come into play on a monthly process? How are you guys working within Treasury and cross-functionally? And how has this really changed the thinking around currency risk management inside of Accenture?
Sure. I guess there's a couple of things, Andy. I think, the first is that, again, given the size of our organization, we could have come at this slightly differently. All the policies and procedures in the world, send me an email when you make this entry so that I can make sure I manage it, type concepts, just really wouldn't work in our environment. And so, one of the things that we found was a fairly high priority was to really base, our improvements on a sort of an industrialized or technology-based solution as opposed to relying on human, procedural types of approaches would kind of be the one thing. And I know I touched on the volume issue before, but I think, the other aspect of the analytics, one of the things we're able to do is we can actually look at this pretty much any day we want. Now, there are certain days of the month where it may not make sense because the close isn't done and there's maybe some balances haven't been updated. But, throughout the balance of the month, we can actually, if we have any, questions or concerns, we're in a position where we can take a snapshot and really, as I mentioned before, sort of separate ourselves from the monthly cycles. And I'll give you an example. One of the things that, we would have never known had we not had an ability to look at things at a portfolio level by currency pair. It's one thing if you've got a euro entity that's got a Swiss franc, exposure, not knowing that you've got a Swiss franc functional entity that has a euro exposure that's going exactly the opposite direction, let's say of almost, identical size and shape and sort of characteristics. And so by looking at things kind of at a total picture, we've been able to, slow down a little bit and say, well, I'm not just going to hedge every individual transaction. Again, we take a more of approach of saying, we're going to hedge everything to its fullest for the period of time that makes the most sense because P&L volatility reduction is our highest priority with regard to this particular program. But at the same time, it allowed us to sort of step back and say, well, hold on, if I've got some natural offset here because the product, the tools are telling me I've got some things I wasn't aware of. That we didn't eliminate a lot of exposures, but we were able to net a lot of them.
That's great, Brian. I appreciate that. Wolfgang, did you have any questions for Brian?
Well, I think that one of the things that, and you guys both touched on it a little bit, and I think Randall did as well, is the whole aspect of, as you talked about and thought about building versus, acquiring from the outside. I'd love to get your feedback of, as you went through that process, how did you think about, well, can we build this internally versus do we want to get experts involved to address this issue? So I'd love to have both Brian and Randall's issues. So maybe Brian, you can start with that thought.
Yeah, absolutely, Wolfgang. So culturally, it may seem counterintuitive because we're a technology company, but from an internal point of view, like our culture is we like to use solutions off the shelf. We don't like to generally do a lot of customization. Having been an SAP shop, for many, many years, one of the things we've systematically done over time as we've put more and more through that ERP solution, we've been steadily decommissioning all sorts of homegrown applications that needed all kinds of customized support. Could we have built this or a solution that would have given us some insights and fully customized it? The capability may have been there, certainly not within our Treasury function, but within our IT organization. But at the same time, it made sense for us. Time to production was a priority, not having to build something that we then have to support. And ultimately, I would prefer to have deep SAP skills where they belong in the IT organization rather than have them in my Treasury shop.
Great. Okay. That's great. Thank you, Brian. What about you, Randall? You kind of went through that a couple times, right, through looking at that. I'd love to get your input as well on that.
Right, we did, and I would say there was a good 2 or 3 false starts to that as we would start to consume some of the IT resources during the interim months of the quarter. You would then maybe get a good run at it, and then you would hit the end of a quarter and you would lose the people that would be validating or the people that would actually be doing the extracts for you because they needed to divert to quarter-end activities or to other projects. So I was really given IT time by the grace of IT. It really was never a dedicated process that we were going to take 6 months of IT time and they were only going to do this. And even if we had done that, if we had been successful at doing that, had an SAP report that would pull that information in, as soon as we did the acquisition in the UK where we had now an IFS balance sheet to interrogate and to pull in, as well as for the revenue and expense, we would have had to start from scratch again because, and using a different set of IT folks because they would have been expert in IFS, how to do the extracts, how to do the combining of that data with the SAP data. So we would always be playing catch-up whenever there was a large change within either an accounting system or through an acquisition. So we actually did ourselves, I think, a service by going to a third party where I like the ability to say, I need this, and they go away and come back and give you the extract and combine the data for you instead of having to work up a project plan and dedicate the IT staff, because you can have a foreign subsidiary or subsidiary network running without exposure management for a number of months while the IT group comes together. I think I had my extract for IFS within, I want to say, 2 weeks by having FiREapps do it for me. So the turnaround time was excellent and combined the data, and we were up and running really without much delay at all.
That's great. Thank you for that input. I think that, we talk to a lot of companies and we do hear the continuous struggle of just getting access to IT to actually schedule anything. Certainly a 6 months project is very different than even a 1 week. Great feedback for that. I really appreciate it. I think I'm sure a lot of attendees can empathize with the issue of trying to get IT time to actually start executing on this, and you having gone through, Randall, the issue of actually trying to look at whether one can build this or not, and then to Brian's point about actually then how do you actually maintain that and and get other systems on. I concur that that's left to the experts, as they say, right? But thank you. I think, Andy, you guys have a quick poll there that you probably want to address.
Yeah, as we progress through the various topics here, we're going to do a quick poll here, and we'll make the results of the survey and the polling available to the attendees after the session here. But this first poll is trying to get a feel for how well companies are prepared to really understand their currency exposures in detail from across their businesses. That's really a foundation for an effective risk management program. So Ernie, let us know when you're ready to transition off of that poll into the next panel section.
Sure, Andy, thank you very much. Just a reminder, we appreciate everyone's feedback on the polling question so we can develop some stronger benchmarking data. Those of you after CPE credits, you'll have to manage the polls as we go through there. I'm going to give the poll about 10 more seconds, and I'm going to go ahead and close. I'm going to go ahead and close this poll. So go ahead, Andy, and transition up to the next section.
Thank you, Ernie. Our next section is going to focus on what we refer to as organic exposure elimination. And this is an area that we've seen a lot of companies spend quite a bit of time over the last couple of years in working with our client base to begin to really understand what they can do internally as a means to reduce exposure, to find natural offsets, to lower the exposure. And it does start with that holistic understanding of exposure, understanding how currencies are flowing through the balance sheet, how they're flowing through the income statement, what are the operational flows that are tied to that. But what our experience has shown is there's sort of three types of exposure elimination activities that take place inside of an organization. The first is very common when companies really start to look at their exposures in depth and can really see on the balance sheet specific flows tied to their cash positions or their intercompany receivables and payables, short-term loans, things of that nature, where they can identify quick wins, where they can find ways to just eliminate the exposures, to reduce the cash positions or to eliminate the intercompany loans. And then we see companies take that to a practice of institutionalizing that either on a weekly or monthly process where they look at the data about their exposures and work cross-functionally on a monthly basis to continue to find those opportunities to leverage cash positions or intercompany positions to reduce exposure. And the final approach is really more a project-based, where the Treasury will sit down with the controller's organization or tax and look at where they can find ways to reconfigure intercompany flows to gain both tax efficiency as well as impact the exposure. And what I'd like to do now is turn it over to Randall. I think with your work with your organization, you probably experienced a very common set of outcomes of that process. Perhaps you could just take us through sort of what you saw up front and how that's transitioned into something that's become a very key strategic part of your arsenal.
Okay. When the quick wins, I think, was probably our greatest impact to the volatility of the FX gains and losses, because we were able to look across the subsidiaries. And as Brian said, oftentimes you will have offsetting exposures and natural hedges that if the individual subsidiaries are allowed to hedge their own exposures, they're actually dealing against each other within the market, and depending upon their timing and their volumes, they may or may not be mitigating the risk. They may actually be increasing the risk to the total corporation. So we were able to look across all subsidiaries by currency pair and come up with a net value, whether it included the cash, the intercompanies, or the short-term loans. Another thing that was an easy win for us was actually the loan classification, because if you can designate a loan as being long-term, never likely to be repaid, it basically has the similar view of being an equity infusion, and you don't have to revalue that to the income statement. You can take that to the balance sheet. So we found several loans that were actually being revalued on a short-term basis just because it was the common practice within the subsidiary to revalue all loans. And instead of doing a proper designation and taking that reval to the balance sheet, we were seeing undue exposure on the income statement. And then we started to actually look at the exposure, because we had the ability to really create it at any time, the output from the program. So we could look at it on a weekly basis to see exactly how the exposures are developing across the month. We have some forecasted hedges that we put on, and we can see how those are being filled in across the month, and look at the success or challenges that we have in the forecasting versus the hedges that are in place. And then we did do some strategic changes to how we're doing business, intercompany flows. We are doing not multilateral netting, but we do bilateral netting with the various subsidiaries in order to reduce some of that exposure that is created on the books by their various sales and purchasing operations. And then we work very closely with the tax department to make sure that when we establish new subsidiaries, we look at the functional currencies that they're going to be established in, make sure that they're added to the exposures so that we see their impacts immediately on the books as well as on the reporting.
That's great. I appreciate that input. I think it's definitely a trend that we're seeing a lot of companies take advantage of, and having that foundation of the analysis and making that the analytical framework available not only within tax or not only within Treasury but within the other parts of the organization does facilitate some great opportunities to lower the exposure without having necessarily to incur the cost of hedging. What I think we'd like to do now, Ernie, in the interest of time, is go ahead and transition to the next quick polling section, and then we will move on to the discussion on risk analytics. So this question here is really looking at how well you're prepared and capable of finding those opportunities to reduce the exposures organically. The purpose behind this question is really meant to what are you able to do without hedging? So what are you able to do to find those nets, those offsets, to eliminate the exposures as a part of your ongoing efforts on a monthly basis?
Okay, great. Thanks, Andy. I just want to give everyone a heads up. We're going to leave this poll up in the interest of time about 20 more seconds. So if everyone we'd appreciate your input. Again, those of you for CEP credits, you're going to need to answer the polling question there. And then, Andy, I'll give it about 10 more seconds, and then you can go ahead and just tee up our next area of the panel discussion.
Great. I appreciate that. Our next section is an area that has been a real heavy focus of our organization, as well as working with many of our clients, to understand how companies can really be empowered, moving beyond just understanding their exposure to really understand what does it mean to the overall risk to the firm, and how that risk information can drive actions within the organization to reduce the impact of that risk on the financial results. What I'm going to do now is I'm going to have Wolfgang introduce this concept. This is an area that he's pioneered with a lot of our clients, and have him discuss sort of the basis of that and give you an example, and then we'll actually turn to both Brian and to Randall to really pick up on their experience in working with this type of analytical framework. Wolfgang?
Thanks, Andy. So the overall gist of this is that historically there had been, certainly prior to 2008, increased focus on just looking at individual currencies and how do they impact and what are the largest exposures and how they impact their financial statements. But as in anything on the financial side, is the evolution of that is that people start to wanting to understand what's the entire portfolio of, in this case, exposures mean to the organization and potential financial impacts. What's the risk and what are the rewards? And when one can do, if one can depict that in a single picture, which is worth more than 1,000 words in this case, then you can also relate that to people that may not be absolute experts in foreign exchange, but really always have this question of what's our real risk? I see these huge numbers from an exposure point of view, but what's the real risk? And what's the cost from a, at least financial products point of view to actually, so at least have a feel for the risk reward of actually managing that risk. So we've come up with a X and Y axis called graph, which is called the core, cost risk evaluation. And what you'll see on the y-axis is the value at risk of the portfolio of currencies impacting the financial statement. And we see that done on only the balance sheet, only their cash flow, or a combination thereof. So what you'll see on the first slide then in this case of an actual customer is, we're not going to disclose, is that their risk of doing nothing is that they had a value at risk of their portfolio impacting, in this case, their balance sheet, was roughly $22 million. What they then wanted to understand as the next one click is to really understand is where are they today as they were mitigating it. And what they found out is that given their exposures, and given that they were really focused on the largest exposures, not necessarily the riskiest, not necessarily the most cost-effective, they found out that while spending roughly $200,000 a quarter in interest rate differentials, which was the basic cost, they were actually reducing their exposure, their risk from roughly $22 million to just over $12 million. So what they really wanted to do is see and understand what's the efficient frontier, as it's often referred to in the asset management world, what's the efficient frontier of their portfolio of exposures to their balance sheet, and they found out really quickly this is where it is. So then they said to themselves, well, what do I want to do with this exposure? One is, I'd like to, on the next slide, then go in there and move actually the red dot down first. So what can I do, to the point that we were making earlier, organically, internally, to offset and reduce my risk created by the exposure? So what can I do there? They did that, and were able to, within 5 months, able to go from $22 million of VAR to roughly $10 million of VAR. Then they said, we want to redraft the efficient frontier on the next click, and that's what this looks like. So then what they were able to do is actually go to management and say, where do you want us to be? Now, they still wanted to be as close to zero as possible, but note here that because of the intelligence, and Randall referred to earlier that they actually were also able to create interest income, they actually here were able to take a $200,000 cost down to actually $150,000 worth of income, while reducing their $22 million VAR to less than $1 million. So we'll, I'd love to kind of get your inputs, Brian, on, as you kind of, I know, went through this process yourself, and then just about, a lot of our customers go through this as they're going through that. And I remember the meeting that we had in Chicago where we pulled the data out, looked at this. Can you kind of give me your feedback and share with everybody the feedback as you went through understanding it for Accenture, what that meant for you, just being able to depict it and analyze it in this fashion?
Certainly. Yeah, it's a little bit of an eye-opener. I think the first thing that we found was, we had some misses. We were, over-hedging in a number of areas because we weren't looking at the appropriate amount of offset. So that, as you said, was kind of the first movement of the needle. I think then when I saw this sort of from an Accenture perspective, sort of retuned, at the end of the day, what we were able to do is to make a conscious decision over sort of where the priorities laid. And our situation is such that, we're in most of our balance sheet hedges, our purchases of foreign currency, just given the nature of our currency pairs, it turns out that, most of the trades are interest income in our favor anyway. But what it did was it allowed us to make a conscious decision and inform our management team that said, if you want to play with some of the other dials, you can do that. Now, as it turned out, the feedback that we got was, okay, understand where we sit today in terms of where our portfolio of currency exposure is, but much like the example you're showing here, our management team said, you know what, drive that thing down to zero as close as you can, within reason. And so what we've taken as an approach is, we essentially hedge every single exposure we can that's of a material nature, where the market lets us, of course, and that's been very successful in driving down that volatility below operating income that results from remeasurement of our balance sheet. So, if we want to tweak that at some future point in time, if the nature of the currencies reverse and it's costing us a little bit more, we're at least in a position where we can make an informed decision, say, do we still want to do that, or do we only want to hedge some of these exposures?
But I also remember you talking about how this would be a pretty informative slide for you to take to your chief financial officer to have a very succinct discussion about this, right?
Yeah, absolutely. And I think you explained it very well, and it's a powerful slide that you can take, 26, 28 different currency pairs of particularly large notional value and kind of distill it down into a kind of a single view.
Great. Thank you, Brian. So I think that Ernie's already clicked on to the next one here, which Randall, I'd love for you to you were kind to share that actual result with us, to go through this, what you found out about it.
Certainly. As we talked about the initial impact of where were we when we started this project, excuse me, and where were we when we went through and did a preliminary review and a preliminary hedging program of those 5 to 10 currency pairs. We were able to drop our currency at risk down over 50%. And so that was great news to be able to share with our CFO, CEO, and the board, and then to use this information to understand exactly the modulation of that risk across quarter-to-quarter reporting, so that we can see if it is growing, if it is contracting, if we need to add additional currency pairs that would potentially come at a cost, but would greatly reduce the volatility. So as a result of that, we've been able to slide along that red curve to continue to bring the currency exposure down and to continue to report out and actually modulate the that volatility even further, and with that opportunity that we have to have some interest income from the forward points on certain currency pairs.
Thank you, Randall. That was a very interesting view of how you guys have looked at this from a currency risk management standpoint. What I'd like to do real quick is we've got one last section that we want to touch on. Ernie, if you want to go ahead and bring up our last polling question, then we'll go through the last section. So this question here is really trying to understand where you are from a company standpoint, where you are in your overall risk management program. The idea is to understand how well you are aligned to understand and manage your exposures, to the extent that you're hedging, and things of that nature.
Okay, great. Thanks, Andy. And being mindful that we'd like to touch on this topic here, why don't you just go ahead and tee up the topic and start that conversation as we keep this poll open around another minute.
So the last section here is really the byproduct of the dialogue that we've had with a number of companies, but specifically with Accenture. One of the interesting transformational outcomes of the program at Accenture and what Brian has led there is really a change in the organizational dynamics around currency impacts. And Brian touched on this. Brian, perhaps you could just talk for a few minutes about how this transformation is really taking hold in the organization, and how you really were empowered to engage the organization to do things that you within Treasury were really not in a position to do by yourself.
Sure. So yeah, I'll be brief with my comments, but I guess the first thing I'll start with is that I sort of claimed victory on this one at the outset with my introductory comments. I would say this is probably the one of our 4 objectives that's never really complete. It's a constant effort. But from an initiative standpoint, I guess there's a couple things I would say. One is, when we were having some P&L surprises due to FX, we implemented the solution to solve that. But what we were then identifying was, well, we're not using what it showed us. The first thing it showed us is we're not using SAP the way that we're supposed to as an organization, because I don't know what I don't know. And if we're not using it real time, FiREapps will show that to you. So then what we were able to do is leverage that and say, hey, this was a CFO priority, guys, and when I can't see what I need to see, we need to fix that, need to correct that. So as part of an overall framework of sort of retooling how our Treasury function works, both from a cash and an FX perspective, we engaged. I don't want to downplay the amount of effort here. There was many workshops. There was lots of calls, lots of telepresence, really going through procedural-based, discussions about how certain transactions and cycles of transactions should work, and who's accountable for things like, clearing this clearing account instead of clearing that clearing account. I mean, it literally gets down into that sort of nuts and bolts discussion. But at the end of the day, like I said, we're never there 100%, but we do have a much better appreciation across many management nodes and finance nodes where journal entries can have a major FX impact. So I'll leave it there just in the interest of time, but it's a very large scale effort, and it does take a lot of time.
Yeah, it's a really critical piece of any currency risk management program, is to gain that organizational alignment. Randall, perhaps you could just touch base on your experience, and then we will move to the closing items.
I think the last comment that I would make is that we did use the output in the system actually to look at our subsidiaries both in isolation and in a consolidated view, so that we could understand what was going on at the local subsidiaries, and we could then actually keep them informed about what we were seeing and how they played a part in the larger organization from an exposure standpoint. And we also helped to identify to them some of the things that were causing volatility on their books that they were not necessarily aware of, nor did they have the tools to drill down into in order to discover them.
That's great. Thank you very much, Randall. Brian, Wolfgang, Randall, thank you very much for your time. We're right up at the top of the hour. Hopefully the audience found the information covered today to be informative and insightful. Ernie, I know you've got some closing action items here, and we can certainly discuss follow-up action items from here.
Oh, thank you very much. Again, as Andy mentioned, thank you very much to Brian, Randall, Wolfgang, and Andy, of course, for your valuable time and insights. Due to the amount of content we have, we didn't get to our Q&A session. However, any questions that you have, any questions that were asked, we will take those online at proformative.com. And also in our survey, we'll be asking you if you'd like to be connected to any of the speakers from today's webinar. So feel free to click that in your survey, and we'll get you connected with the speakers if you have any questions for them. I'd like to once again thank today's sponsor, FiREapps, for allowing us to make this event possible. Appreciate their commitment to thought leadership. As a reminder, those of you looking for CPE credits, T. Walsh at performative.com if you have any issues on that front. And finally, I would like to thank our audience for their valuable time. And we look forward to seeing you on performative.com and also on future events that we will have on this very topic with FiREapps. Again, thank you very much, everyone, and have a great day. And this will conclude today's webinar.